Hitting just as the global economy was regaining its footing, our next guest says the coronavirus outbreak is a net negative for China, Asia, and the global economy in that order of intensity. Simona Mocuta is with State Street. She's the global advisor, senior economist. She joins us now. So if coronavirus is worse for those economies that are closest to the epicenter, is there any reaction here in the U.S. that is actually playing into the hands of equities here because it is becoming, which is hard to say because we keep talking about it, a safety trade to come in and keep investing in the U.S. because it's so much better than the rest of the world?
It's actually almost reinforcing that divergence. We've been talking about this U.S. outperformance for quite some time. And as we were going into 2020, our expectation, our outlook was calling for a narrowing of that divergence. And then the coronavirus hit. So I think the divergence actually persists longer and is more pronounced. And I think so the regional sort of differentiation in equity market response reflects that view as well. It makes sense to me.
And so we've seen some initial reaction to the coronavirus, but certainly I think the longer-term impact on the Chinese economy specifically, and I think broader Asian economy, is probably not going to be known for a few months. Does that remain an outstanding risk to the market, or are we going to get a 1% China GDP print that everyone says, no, we priced that in, it's fine, we're already moved on to the next thing?
So I think there's still going to be a bit of a sticker shock when the bad data starts to come through. Right now, everybody expects the data to get bad, but we haven't seen it yet. But I think still, at the end of the day, this is a transient impact. So I would not discount China's long-term growth trajectory because of this shock.
So when we talk about, I guess, the concern, the equity market is telling one story. We've been hitting all-time highs. But when you look at debt markets, I think it's a little bit different. The 10-year Treasury at 159 right now, that's touching the lows that we saw when the trade war was really at its worst in the late August last year. I'm wondering how you read into fixed income right now, and what does that tell you about the concerns regarding just globally? Maybe some of the trade concerns going away, but the coronavirus concerns entering in.
That's right. We were only enjoying about a 3-week period of peace and improving risk balance, and now it's worsened again. What is interesting to me is I look at the bond market and at the Treasury yield as more of a reflection of the global economy situation, and there is no question that this coronavirus is a net negative. So I would expect, therefore, the rates market to respond to that. When you look at the equity market, the response is different. As we talked about, far less negative here in the States, but fairly negative in Asia, in specific markets in Asia. So I wouldn't call them entirely disconnected because of that.
Focusing on the labor market here, you note that, look, the last jobs report was great. You'd have to be picky, basically, to find anything that was wrong with it. But now we have a JOLTS number that people are examining, the December number showing that job openings have dropped to their lowest level in almost 2 years. Does that concern you?
It does. I wouldn't say it's an acute concern, but people have been asking me for a long time, what are the signs of a late cycle in the U.S.? And a year ago, it was, to me, pretty hard to find evidence in the labor market data, any data, that we are late cycle. I would say the JOLTS, the clear peaking in the job openings and the fairly notable downturn of the last 2 months speaks to me about late cycle. I still believe that there is a chance for that to turn higher still, but if you're not having abundant job openings, it's going to be hard to defend the 200,000, employment number going forward.
And I guess then the question becomes, if the data starts to look a little more spotty, but the Fed is so acutely aware of any of those slip-ups, at what point would the story change for markets? Because essentially right now you just say, well, the Fed's going to be easy, so everything's fine even if the economy rolls over.
I'm not looking at the Fed to put the backstop here, although, of course, it's going to help, right? Any sort of encouraging, supportive message is helpful. What I'm looking for is for the global economy itself to get over the coronavirus shock and to get back to that bottoming out process that was being put into place. And if you look back at where we were in 2016 and the industrial cycle pickup, you can potentially see a pretty significant upturn once this coronavirus subsides. So to me, that would be the big positive.
It seems like qualitatively, based on the Fed speak recently, especially with Jay Powell today, nothing's really going to change on interest rates. But then you have some shops like JP Morgan Chase saying, actually, we are pricing in a 25 basis point cut maybe in June with seemingly no reason. I'm wondering, when you look at forwards, do you also agree that maybe we might see one rate cut this year?
I would say if we see a rate move, it will be a rate cut. It's not yet part of our baseline expectation based on this assumption that coronavirus is transient and we go back to the sort of bottoming out and improving trend. But if we are going to get a move from the Fed, it will be a cut.
Thank you so much, Simona Mocuta, State Street Global Advisors Senior Economist.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.